And one more thing I wanted to talk about was the VIX options. We'll spend maybe the next 15 minutes. And if you have any questions about any of this stuff and we're talking about something else, instead of going off topic, you can put whatever questions you may have on Discord, and we'll answer all of the questions. So let's talk about the VIX and VIX options. One of the biggest things I see, or one of the biggest mistakes people make, is they look at VIX and they think that, oh, VIX is going higher, I need to go out and buy some calls on the VIX. And nothing wrong with buying calls on the VIX, don't get me wrong. Right, this is going to look a little bad because I can't move this. But anyways, the VIX right now is at, are we at 14? Something like that, right? And last couple of days, the VIX has been kind of drifting higher a little bit, where we are currently at 1370. So when the VIX is low, it makes sense, right, to buy protection. But it's not necessarily protection because you think the market is going to decline. There are times when market declines and VIX doesn't do anything. It's about the speed at which the market is moving, right? If the market is moving fast, you're probably going to see a response in the VIX, right? The VIX is just, it's telling us about the demand for options in the S&P 500. Right? So if the market is moving slowly and the market is boring, right? The market participants aren't really buying calls or puts, right, to protect themselves from a big move in one way or the other. So the VIX, if the market is declining slowly, the market participants aren't going out and buying puts on the S&P 500, so VIX doesn't really register, right, that decline. Especially now where we have so many different expiration cycles. We have SPX options that expire every single day, right? So for example, like 2 days before the election, or maybe 5 days before the election, right? If this was 15 years ago or 20 years ago, where you only had monthly expirations on the S&P 500, with 5 days until the election, you would have to buy whatever the corresponding monthly expiration in the S&P 500 to give yourself protection. Now we don't have to do that, right? Because if the election is on Tuesday, I could buy a Monday expiration puts. I can buy a Tuesday expiration puts. I can buy a Wednesday, Thursday, the weekly, the Friday expiration, right? I no longer have to go and buy a monthly S&P puts. So I think the VIX right now is not truly showing us the demand for options the way it did years ago. Now I can make the case that VIX doesn't work, and it doesn't work until it does, right? When we get a move that's big enough, VIX is going to show, and you can see on this chart here that as much as VIX doesn't work, when market falls out of bed, this is going back to August, that move definitely registered. And it wasn't even the move, right? It wasn't the move. It was just drastic increase in demand for S&P 500 options, mostly on the put side, right? So when demand for option increases, the weeklies are going to go a lot higher than the monthly, because VIX only looks 30 days into the future. But if you look at the VIX 9 days, right, you can see that VX9D, I think that's the ticker symbol, VIX9D, that one went to as high as, I think the high was like 76 on August 5th, whereas the VIX, which is a 30-day forward-looking, only went to as high as 65. It still went up a lot, right? So now, if you say, okay, the VIX is low, right? VIX is at 1375 right now. I would like to hold some kind of an insurance policy because VIX might freak out sometime next year and go to, I don't know, 30, right? Which is historically 30 is elevated VIX. It's actually considered to be high, right? If the average, historic average on the VIX is about 18, right? Anything above 20, you should expect a 1% or more move in the markets in the S&P 500 on a day-to-day basis, which is, quite volatile. And then when the VIX gets to 30 plus, now we're moving, two standard deviations up, two standard deviations down. And if we do that every day for, a couple of days or a week in a row, VIX is definitely going to register that, and you're going to see a spike in the VIX. Now, here's where most people make mistakes. Just because the VIX is at 13 right now, say you wanted to take protection or some kind of play on VIX for, let's say, June of next year, right? And we can look at the VIX options, but VIX options for June, which is 187 days, they're not priced based on the VIX that you're seeing on your screen when you type in the ticker symbol VIX, right? The VIX options are priced based off of the corresponding VIX futures contract. And if anyone ever saw the chart from VIXCentral.com, I'm going to try to share this with you guys. Where is VIX Central? Hopefully you can see that. All right. So we're talking about VIX in June. Well, VIX in June is at 18 right now, whereas cash VIX is at 1375 or 13 whatever. All right. So there's a 5-point difference. So if you went out and you bought a $14 call in June, you're buying that call $4.50 in the money. Right? That doesn't make sense. You don't want to pay $4.50, right, for that call because it's, you're paying that intrinsic value. And if the VIX is going to, over time, right, these VIX futures contracts are going to drift closer and closer to where cash VIX is. And let's just say nothing changes. VIX doesn't spike to 30. Nothing happens. VIX goes to where, $14 or whatever. You're going to lose that extrinsic value. It doesn't make any sense to lose the extrinsic value, and you're paying $4.50 of intrinsic value in that contract, which will be lost, and there's very little you can do about it. One way I like to do trades in the VIX, and I think that, June VIX at 18, I'm not going to tell you that, VIX is or isn't going to be at 18 in June. I have no idea, and neither do you or the next guy, or no one knows, right? But I think June 1850 is pretty elevated already, right? So the only thing I'm going to play for if I am going to do a trade in June is for some sort of an outlier move. Now, I'm not talking about VIX going to 100, but anything above, 30, 35, 40, 50, and higher, that's an outlier move in the VIX. As you can see that, when the market freaked out in August, VIX went to 65. In 2020, when COVID hit, VIX went to, what did VIX go? In 2020, VIX went to like 85. Right. So these are outlier moves. They don't happen often, but every now and then we do see VIX go as high as 35, 40. Right. So maybe and this is a pure speculation. This is a pure spec trade. I don't necessarily know how to exactly quantify. Like, for example, if you say I have a $100,000 portfolio, how many VIX spreads should I do? It's very hard to tell because number one, if it's just portfolio of long equities, then maybe you can beta weight it to S&P and then find a correlation of S&P to VIX and based on that figure out some sort of ratio, how many spreads you need for every 100 shares of SPY or something like that. But if your account is 100,000 and you're holding a bunch of 112s in them, which will change probably 30 days from now, and 30 more days from then, it'll change even more, then how do you exactly know how many VIX spreads you need? It's kind of hard to guess. You can probably do it with the dollar amount, saying, if the VIX goes to 35, my portfolio is going to be down X amount of dollars. So maybe I can buy enough call spreads where if it does happen and the VIX goes to 35, it'll cover the losses. Maybe do it that way, kind of reverse engineer. I'm not sure exactly. So I'm not going to tell you this is the right way to do it. But the way I like to play this, and I don't want to spend a ton of money on VIX premium because, unless you're like that, if anybody remember the 50-cent trader that would come in and buy up 50-cent calls in the VIX and would lose money for like 2 years in a row or something like that. And, he was in the news every now and then. They would say they just keep burying 50 cents at a time and it would buy like, millions of dollars worth of VIX calls until 2018, where they cashed in. And not only did they make up everything that they spent for 2 years prior to that, they made millions and millions and millions, but they were consistent. They would come in and buy these 50-cent VIX calls. And to me, it's a little difficult, right? I mean, you have to continue to spend and spend and spend, and you now at some point you've buried so much money into these VIX calls that now you kind of want the market to crash. I don't want the market to crash, so I can't get behind an idea like this. But what I can get behind is structuring a trade. This would be kind of me and Tom spoke briefly earlier today about a trade which is a bull combo where you're buying a call spread and you're financing the call spread by selling out of the money puts naked. Right? So you sell the out of the money puts naked, you collect in the credit, and then you leverage that credit. You're not trying to make that credit. You're leveraging that credit to pick up an out of the money call spread and end up in a net zero out of pocket expense. From there, you have two potential outcomes. If you're right and you get some sort of an outlier move in the VIX, and hopefully your call spread goes in the money, you'll make a lot of money, right? If VIX doesn't move or you don't get that spike you're looking for, if your out of pocket expense is nothing, zero, you paid no debit, you lose nothing. The only really downside is if the VIX goes down low enough where your puts that you're selling to finance this whole deal, if those puts end up in the money, you have a problem. So the way I go about it, the way I think about it is, where do I think that the VIX will not go? Will the VIX go to 9 in June? It's very unlikely. And we can look at, the VRO is the ticker symbol for settlement value for VIX options. And we can compile enough data going back to like maybe 2007 to see what the average closing price for VRO was in June, July, and August, or April, May, and June, and July, and kind of come up with some sort of an average number. I just literally gave it one glance, and what it looks like to me, VIX doesn't really go much lower than, say, 14 or 15. Sure, there were a few times where the VIX in the summer was like at 11, right? 2014, 2016, I believe that was. But it's not very often that it happens. So what I'd be willing to go and say, I'm going to sell, and hopefully you can see my screen. So now we're just looking at June VIX options. Let's remember, VIX options for June are not based off cash VIX, what you're seeing right now in the ticker symbol VIX. You have to look at the VIX futures contract, and VIX in June is trading at about 18 and a half. So if I'm going to sell maybe a 15, that's a little, I mean, I like it. Dollar 10, right? You can see delta. This is deep in the money, even though you may think, well, 15 for June, VIX is at 13. Yes, these are deep in the money because at the money for June, these options are at 18 and a half. Right? So let's look at this scenario. If I sold one, and even in Option Explorer and every other brokerage um, analytical tool, it's going to look ridiculous because this isn't accurate. Again, this software doesn't take into account the fact that these options are based not on cash because, right, the software thinks that VIX is at 1371, and it is, but we're talking about June VIX, which is not at 1375. It's at 1850. So I'm just curious about the risk graph at expiration. I am not, I don't care too much about, what it looks like in the money or out of the money. I know what in the money is, and I know what out of the money is by looking at the VIX futures contracts. Hopefully, we're on the same page here. So if I was to sell the 15 put naked, right, what is my risk? Anything above 15, no risk, right? Anything below 15, now we have a problem, right? So I think every 1 point is $1,000 in the VIX. So if you sold one put and it settles at 14, you're on the hook for $1,000. And these are cash settled. So there's no early assignments. You don't have to worry about that. There's no dividends. So you don't have to worry about that. You just have to worry about where is the VIX going to settle for the month of June. Right. So if you think that, VIX isn't going below 14, right? Because if we sold at 15, we took in $1, we have 1 point of room to the downside. But we're not looking to make this $1. So what we're going to do is we're going to take this dollar that we're collecting for the short 15 puts, and we're going to leverage this dollar. What can we buy for $1? Right? Let's say we're going to bet that VIX is going to go above 30. So we'll buy a 30 call. Okay. Now I took in $1.11 from the short 15 put. I spend $1.55 on the 30 call. I have a deficit of about 40. Let's just call this 50 cents. So now I need to go out and sell something for 50 cents. About a 60 call minus one. All right, that's more like it. All right, so I collected $1.11 for the naked put, and then I spent this $1.11 on 30-60 call spread. Unfortunately, I can't zoom out anymore here. But as you can see on this risk graph, and this is at expiration, I don't care if what this T plus 0 really looks like right now. I just care about where the VIX is at expiration. As long as it's not below 15, I don't have a problem. Because what's going to happen is if it's above 15 but below 30, my net in this trade, I'm actually taking in a small credit here. So I'll take in a small credit. The real risk here is, I think, it's an opportunity loss because this will take up some margin. Not a lot, right? But it will take margin. And if you do it in size, obviously the bigger the size, the more margin you'll have to put up, and you'll have to tie up this margin until June, right? But I don't think VIX is going to crash. So you don't have the risk of, buying power tripling or quadrupling on you. I don't think that's the case, right? We rarely see VIX go from 13 to 7, right? So I don't think the downside is as scary. So selling naked puts is not as terrible of an idea. But again, for those that have never sold puts naked, this isn't the time to try this out. Even if the risk doesn't seem like it's great, but it is. So we took in $1.11. We spent most of it on this call spread that's 30 points wide, which means that if the VIX is between 30 and 15, we make the very tiny credit that we collect up front, 7 cents or 5 cents, whatever it's going to be. If the VIX is at above 30, now we have a call spread that's 30 points wide and could potentially be worth something. So if we're at 31, this call spread is worth $1. 32, it's worth $2. I believe it's $1,000 for every 1 point in the VIX contract. So if the VIX does explode and we go to 40, right, this trade could be worth one lot, could be worth as much as at expiration. It could be worth as much as um, well, the software is showing $1,000, so I believe it. So maybe it's $100 for every 1 point. If you do them in 10 lots, it's $1,000. But now all of a sudden, so you have to put up some margin. I don't know what exactly that number is right now. I haven't modeled this trade to look at it, but you have to put up some margin to put this trade on. You have no cost, which means that if the VIX stays at 18 or it goes to 19 or it's 17 or it's 16 at expiration, you lose nothing. You'll make very little, which will be very little return on the buying power that you have to put up. But if you're right and VIX does explode higher, right, anything above 30 at expiration has intrinsic value, and that return is going to be quite a bit. Now, you would have to, play around with this a little bit and kind of model this trade to see what exactly your payout would be. It's very hard to quantify because we don't know when or if the VIX is going to go up, how long it'll take to get there. Say, I don't know, you're betting on VIX going to 50. When? Is it in June? Is it in May? Is it in April? Is it next week? Right? So it's kind of hard to guess exactly what's going to happen. And because that is a major variable, it's one major moving part, that's what makes it very hard to say, do 5 of these for every $25,000 you have in your account. Because if this move happens very slowly, right, if the VIX just goes to 25, but it happens over, 6 months, right, your positions may be in trouble, but this hedge is going to lose most of its hedging power because it takes so long to get there, right? So that's one thing to consider, is that you have to be right not just on direction, you also have to be right on the speed of the move. But the idea, I hope that it's kind of clear, and it doesn't have to be these exact same strikes, guys. You can model whatever makes most sense to you, right? You figure out where you think the risk is not as great of VIX being at expiration. Maybe it's at 15. Maybe you say, you know what, I'm not so bullish on the VIX. Maybe it's 14, but then you cannot do 30 point wide because there will be a debit. And maybe you say to yourself, you know what, I don't mind paying a small debit. That's the cost of having that, freak out insurance. And that's fine too. But if you didn't want to have a debit, then either you're moving your short leg down, maybe it's 10 points, that's not enough. Maybe you're moving it down to 45, that's still not enough. Maybe you're moving it down to, what's that, 30. Here you go. So maybe you're moving it down to 40. So it's a 30-40 call spread for, maybe you can, if you work this, maybe you can get it for even money, right? So you spend nothing. The only thing you have to put up is margin to hold 14 put naked. right? Short, 14 put naked. Whatever number works with you. So you want to get a little more safety on the short put, then you'll have to shrink the size of your call spread, or maybe you'll have to go with like a 50. Maybe you can go to 55. Right, but you get the idea. So you'll have to play around with whatever spreads make most sense. But I think the driver here is number one, you figure out where do you think the VIX is not going to at expiration, 14 or lower, could be 15 or lower, whatever the case may be. And whatever you're able to collect as far as premium goes for that put, you're going to leverage that put to buy a call spread. And again, depending on how much you collect for the short naked put, and depending on where, I mean, you can leverage to a point where I think it doesn't make any sense, like buying a 60 90. It's very unlikely. I mean, unless you're betting on some kind of a, I don't know what even to call it, right? Chances of VIX going above 60, you have to see not only a move that we saw back in August, but that move has to be sustained for quite a while. Like it's gonna take like the 2008 kind of a sell off for, and let's see, what did the VIX do? Hang on, I'm just looking at the VIX in 2008. 2012 was fun if anybody was around, but in 2008, but VIX, it was between 25 and 30 or something like that. And then it really, in September 2008, it took off from about 19, went to like 95, and it was elevated. It was between, 53 and as high as, low 70s for, it started in October, or let's say it started in September, but then in October it was already in the 50s, and it didn't really come down until December. So for 2 good months, it was, in that range. But again, something like 2008, is it going to happen next year? Maybe. It probably won't, right? So don't bet on it. But if you wanted to take one of those YOLO bets on the VIX, where you don't have to put up a lot of capital and you stand to lose nothing if you're wrong, I think a setup like this makes sense. Um, if I do figure out a way to quantify it and pivot it around some kind of a dollar amount portfolio value, I will definitely share it with you guys. But that's one way I look to buy the VIX. I don't like to buy these 50-cent calls, and even though buying a 50-cent call, so you're betting on the VIX going to 60, you're betting on the VIX going to 55. VIX could go to 30, and if it happens fast, these calls are going to be worth something. But if the VIX is at 35, but it takes a long time to get there, even these 50-cent calls are gonna get smoked. So that's why I'm not a big fan. So I don't want to put 50 cents, time in and time out for 2 years. I'd rather do this for 2 years. Right? I'm just gonna recycle the same buying power, and I lose nothing. Maybe I'll make a small credit. Maybe I'll pay a tiny debit, like 5 cents. Right? But if you're gonna do it in size, even 5 cents, it's gonna add up. Right? So you can run this for a couple of years. Eventually, VIX is going to spike. I mean, I don't want the market to dive. I don't want people to lose money, but we all know that from time to time, volatility is going to, get out of hand. Market's going to do whatever. Something's going to happen, and the fear is going to return. When we don't know. So if you want to take advantage and do something like this, I think it's one way to make it makes sense. And one other thing that I wanted to share with you guys before I let you go is the chart that I use. I probably should have led with that. But the chart, right? How do we know? Bob is saying Toss has a BP of 1493. Is that per one contract? So short one put and long one call spread. It takes $1,500. It's probably less if you do it in the portfolio margin account. I mean, I've um, done this trade before, and yeah, so it's really not that much. I mean, I think this sounds more like a Reg T or a retirement because VIX at 14, right? One contract has if it's a it, if the multiple is 100, not 1,000. But and I think I was wrong. I think the multiple is 100. I was doing like a couple of hundred lots before, and so if the multiple is 100 and 14 times 100, if if right, if you're selling a cash covered put, in that $1,400 for one short put at 14, I think you know what? I'm gonna stop thinking. Let me just jump on this thing real quick, and I'll tell you exactly what a portfolio margin BP for this VIX short. Hang on, bear with me. So while this thing is going to load, I'm going to show you. So I want everybody to pay attention to this chart here, right? This is VVIX, which is the VIX for the VIX, right? Kind of sounds tricky, right? Just like S&P has the VIX, which tells us about the demand for protection on the S&P 500, VVIX is the VIX for the VIX. It's telling us about the demand and supply for VIX options, right? Let's see, June 14, if I sold. Huh, that's interesting. So on the Thinkorswim, the VIX June 14. Oh, we were talking about 15. Okay. Selling a 15 put will take up $558. Right. So maybe about a third. And then if we were to use this 110, what do we talk about? We talk about buying a 30, selling a 60. Yep. So the margin for this bull combo, short 15, long 30, short 60 call, the margin for one lot is 558. Right, and the risk is if the VIX is at 13, right? The VIX is at 13, you have a $200 loss. If the VIX is at 10, you have a 5 point or $500 loss. But again, I don't think the risk is as great because I don't think that the VIX is going to go from 13 to 6. I think the lowest we saw VIX is at like 9. And that was, you know, when the market hasn't moved more than 1% up or down for like a year straight, right? So very low volatility, very low. Market was extremely complacent. So the chart of VVIX tells us about the supply and demand for VIX options. This is kind of a guide to tell you when this trade makes most sense. So if the VIX for VIX is high, right? So for example, let's go back to S&P 500. If the VIX is at like 30, do you want to go out and buy S&P puts? Maybe you do if you need protection, but you know that you're overpaying for them, right? VIX is at 30, tells you that S&P 500 puts are stupid expensive. Same thing here, right? You can kind of eyeball and figure out a range. So you can see that after COVID, right, VIX spiked, demand for VIX option was through the roof. And then we kind of stayed in this elevated, relatively speaking. But this was the norm then, right? Maybe we can draw some kind of a regression channel to figure out what, and I don't want to extend it. Don't extend it, right? So this was the norm then, right? Some kind of an average. So 133 and maybe the low end was like 103, right? So the 30-point range where if you bought VIX protection when we came down to the lower end of this channel, it made sense. You don't want to buy VIX options when we're on the upper end of this channel, right? So we stayed in this elevated range for a little bit. And then look at this 2022, right? 2022, bear market. But look at the demand for VIX option. It falls through August, right? Am I making a mistake? 2022 was a down year. 21 was a really strong up year. And in 2022, I think S&P was down 17 or 18% on the year. But the demand for VIX options was really low, or relatively speaking, right? So we went into a different environment for the VIX options where this was the new norm, right? And I kind of have like this channel where, the low end of that channel was somewhere in the 80s, and the higher end of that channel, right, from 2022 all the way through, right, until until August. So the low end was in the 80s and the high end was in the, 110-ish. And then we had August where VIX once again spiked. And then we're staying in this kind of a high. We never came back down to the previous low end of, right? So we're in a different market environment for VIX options. And now we're kind of coming back down. So, in early December, we were on the lower end of this range. Now we're kind of halfway, not here nor there. So is it safe to say that right now VIX options are overpriced? They're not overpriced, in my opinion. They're definitely more expensive than they were just a couple of weeks ago, but they're not expensive is up here or higher, in my opinion. So would I be willing to initiate this trade now? Or would I be willing to be doing something in the VIX now? Yeah, why not? If the VIX options were priced with VVIX trading at 120 or higher, it's still not a terrible trade because remember, we're not laying out any money, right? We're not putting anything up front. We're selling a put, which technically should be more expensive in implied volatility terms, right? When VVIX is higher. So because there's no cost other than the buying power that you have to put up to put this trade on, this, reading this chart is not as important. But you kind of want to get an idea. When does it make sense to put on a VIX hedge or this YOLO bet or whatever you want to call it, right? When the market is most complacent, right? If we're going to find when the market is fearful or when the market is complacent, right now we're kind of halfway. We're not really, we don't know what to expect, right? The market is not really freaking out and, rushing in to buy VIX calls or puts. And so we're kind of in the middle of the range. But when the market starts to get complacent, and we can stay complacent for a while, right? That's why I want to give these trades a lot of time. Go out 6 months, go out 9 months, right? The more coverage you have, the better. You sell a put where you don't think the VIX is going to be at expiration, and you use that credit to pick up an upside call. The only thing I would say is, don't go crazy buying, 80, 140 VIX calls, because even if the market does panic out, it's very unlikely you're going to be able to cash in unless it happens really fast and it stays there for a good couple of weeks to give you a chance to get out. All right. So I think that this is it. That's what I want to talk about. Hopefully this was clear. If it isn't, I would love to talk more about this. Maybe some follow-up questions to give me an idea of what wasn't clear, or maybe if I made mistakes where I was wrong about this assumption. And we could continue to have this conversation. But for those that were talking about VIX options earlier this week, and I saw some back and forth conversations, I think this could potentially give you something to think about. Please don't take this as a financial advice.